Welcome to Breaking News to Trading Moves.
It's good to be here.
So we need to talk about the Microsoft earnings report.
You too.
Because honestly, if you just, glanced at the headline numbers, the top line revenue, the EPS, maybe over your morning coffee,
You'd be confused.
you would be completely scratching your head looking at the charts today and seeing all that red. The numbers on the surface they looked fine.
Solid, even. But fine is probably the most dangerous word in this kind of market.
How so?
Well, let's say a normal environment, a double beat, you beat on revenue, you beat on earnings. That's a victory lap. You celebrate.
Right.
But this isn't a normal environment. We're deep into the show me the money phase of this whole AI story.
That's a great way to put it. The market has moved past the AI is a cool new thing phase and is now squarely in the AI is incredibly expensive phase.
And that's exactly where the tension was this quarter.
So the stock drops after hours, not because the business is in trouble, but because the bill for building the future just got dropped on the table.
And it was much, much higher than anyone had modeled. It was a real sticker shock moment.
So we have this divergence. On one hand, a company that seems to be executing pretty well. But underneath all that,
There's this massive reallocation of capital, just a fire hose of spending that is making investors who are, obsessed with margins, very nervous.
Let's get specific about that sticker shock then, because we're not talking about a small bump in the R&D budget here.
Not at all. We're talking about a capital expenditure number that just sucks all the air out of the room when you hear it on a conference call.
Microsoft's AI Capex.
That's the one.
The number was what? Around $37.5 billion?
Approximately $37.5 billion.
For the quarter.
Just for the quarter. In 90 days.
You really have to pause on that for a second. $37.5 billion in 90 days. If you even try to annualize that.
You're talking about spending that is more than the entire market cap of some very large, well-known companies. Think of a company like Intel or Boeing. It's just a different scale of spending.
And what does that look like in terms of growth?
Context is key here. That number is roughly a 66% year-over-year increase.
66%.
They've ramped up their spending on infrastructure by 2/3 in just 1 year. And the scary part for Wall Street,
What's that?
the CFO, Amy Hood, basically signaled that this isn't stopping. It's not a one-time thing.
That's the real kicker, isn't it? Because if you spend that kind of money, the story you want to tell investors is, don't worry, this is a one-time build-out, and then we're done.
But they didn't say that.
Yeah.
They effectively said, get used to it. This is the new cost of doing business in the AI race.
And that brings us right to the friction point.
It does. Because when you wire $37.5 billion to your suppliers, the market pulls out a stopwatch. They want to see revenue velocity match spending velocity.
And the stopwatch ran out on them this time.
It feels like it did. You look at Azure growth. That's the proxy for all this AI demand, right?
Yeah.
It came in around, 32%? Which is great growth for almost any other company on Earth.
Yeah.
But when you're spending this heavily,
It was just barely a beat.
it was an inch pass scenario, as some
Yeah.
people call it. The revenue growth looks kind of linear, but the spending is going up exponentially. And that mismatch is what we need to break down.
So the market's reaction, it's pretty harsh. It feels almost punitive.
It's skeptical. Investors are looking for clearer proof. They're doing a very simple calculation in their heads.
Which
Is all this record-breaking spending actually turning into faster growth with higher margins?
And the immediate verdict from the market was no. Or maybe more accurately, not yet.
Exactly. Not yet. The stock slid because the proof just isn't clear enough. The market is saying we see the cost, we see it loud and clear, but we are not seeing the profit acceleration to justify it.
Okay, that really sets the stage. Microsoft is spending a fortune to build out its AI capacity. The market is punishing them for it because the payoff isn't instant.
Right.
But here's the thing about spending $37.5 billion. That money doesn't just, vanish.
It has to go somewhere. One company's expense is another company's revenue.
And that's what we're going to do here. We're going to follow the money. We'll look at who wins when Microsoft writes that check. And then we'll look at who loses when the market questions the return on that check.
Sounds like a plan.
So let's start with the first group of winners, the most direct ones, the people who are actually receiving that money.
The builders, the tool makers.
So if Microsoft is spending all this money, where is it physically going? What are they buying?
They are buying the picks and shovels for the AI gold rush. It's that classic playbook. The immediate beneficiaries are the suppliers of the core equipment.
And what does that equipment consist of?
We're talking about the absolute essentials. The chips, the servers that hold the chips, and the high-speed networking gear that connects all of it together inside these massive data centers.
It makes sense. You can't have an AI cloud without the silicon to run the models on.
You can't. The correlation here is almost one-to-one. As long as Microsoft and its competitors feel the pressure to keep building out capacity,
Which it seems like they do.
then these suppliers have a guaranteed, locked-in revenue stream. Microsoft simply cannot stop buying this stuff if they want to stay in the game.
Okay, so let's break down the specific tickers then. Who is at the top of this food chain?
You absolutely have to start with the primary supplier of the AI brains, and that is NVDA.
NVIDIA.
Yep. If a hyperscaler's Capex is going up, NVIDIA is selling more units. It's really that straightforward. A huge chunk of that $37.5 billion is being converted directly into NVIDIA GPUs.
It seems obvious, but let's dig in a little more. Why is NVIDIA so dominant here? Why can't Microsoft just go find some cheaper chips somewhere to save a few billion?
Two reasons, really. The first is the software ecosystem, CUDA. It's the programming language that all the AI developers know and use. It's sticky.
The second reason,
Sheer performance. The performance density of their H100s and now the upcoming Blackwell chips is just unmatched. In AI training, time is money. A lot of money.
so if you buy a cheaper chip, but it takes you twice as long to train your model.
You've actually lost money, you've burned more electricity, more engineer time, so these hyperscalers are willing to pay a premium to NVIDIA for speed, for velocity.
And there's a competitive angle here too, isn't there? A sort of prisoner's dilemma?
Oh, absolutely. If Microsoft hesitates on an order, Google will take their spot in the queue. If Google hesitates, Meta or Amazon will jump in. Nobody wants to lose their place in the supply line, so there's a very strong floor under the demand.
Okay, so NVDA is the clear number one. Who else is getting a piece of this action?
Next up, you have to look at AVGO, which is Broadcom.
AVGO. What's their role in all of this?
They're critical in two areas. The first is networking. You have to connect tens of thousands of these GPUs together, and that requires very specialized high-speed silicon. Broadcom makes a lot of that.
In the second area, you mentioned custom chips. I thought NVIDIA was making the chips.
NVIDIA makes the general-purpose GPUs, but to reduce their long-term reliance on NVIDIA, Microsoft is also trying to design its own custom AI chips. The project is called Maya.
And they don't do that alone.
No, they partner with a company like Broadcom to help design and build those custom ASICs. That's application-specific integrated circuits. So Broadcom's in a great spot.
How so?
They win if Microsoft buys more NVIDIA chips because they supply the networking components. And they also win if Microsoft succeeds in building its own chips because they're the design partner.
That sounds like a very strong competitive position.
It is.
Now, speaking of networking, there's one more name that's almost a pure play on the speed of data transfer inside the data center.
That would be ANET, Arista Networks. Arista is all about high-speed networking. When you build these giant AI clusters, the data has to move between the servers at unbelievable speeds. Arista provides the switches, the networking fabric that allows that to happen.
I know there's a bit of a technical battle going on between networking standards, InfiniBand versus Ethernet. Where does Arista fit into that?
That is the key debate right now. NVIDIA, which bought Mellanox, pushes its own proprietary standard, InfiniBand.
Okay.
But Arista is the champion of high-speed Ethernet, which is the open industry standard. And the fact that Microsoft is spending so much is actually seen as a positive for Arista.
Why is that?
Because as these GPU clusters get truly massive, we're talking 100,000 GPU clusters, many engineers believe that Ethernet is more scalable and easier to manage, especially for the back-end network. So a lot of this spending is flowing their way.
So just to recap this first group, Microsoft cuts the check, and that money flows directly to NVDA for the processing power, AVGO for the custom silicon and the interconnects, and ANET for the data switching fabric.
Correct. Those are your core digital infrastructure winners.
But it's not just about digital infrastructure, is it? You can't just buy 100,000 GPUs and, stack them in a corner.
No, you cannot. And that brings us perfectly to our second group of winners, the companies that deal with the physical reality of all this spending.
Right, because these chips are physical objects, they take up space, they use a ton of electricity.
A shocking amount of electricity, and they generate an incredible amount of heat. So beyond the chips themselves, you have to build a place to put them and a system to keep them from melting.
So this requires a whole other layer of physical infrastructure.
It does. Things like industrial-grade power distribution, specialized electrical gear, advanced cooling systems, and, of course, the actual data center buildings themselves.
So we're really talking about the industrial side of the tech world, the concrete and copper part of the story?
Exactly. When you see a term like hyperscaler Capex ramps in a report, that's a direct signal for these industrial players. You cannot power up an NVIDIA chip without the gear to feed it electricity and the cooling to keep it stable.
Let's talk more about that heat problem. I read somewhere that the power density in a single server rack has gone from maybe 10 kilowatts a few years back to potentially over 100 kilowatts with these new Blackwell systems. That sounds like a fundamental physics problem.
It is a massive physics problem.
Yeah.
That kind of power density completely breaks traditional data center designs.
Oh.
You can't cool a 100-kilowatt rack just by blowing cold air at it with a big fan. The air physically can't remove the heat fast enough. You need a new approach.
So who are the tickers that are solving this problem? Who's dealing with the heat?
For that, you really have to look at a company like VRT or Vertiv. Vertiv is focused specifically on this: critical digital infrastructure, and most importantly, cooling. As these chips get hotter, technologies like liquid cooling are no longer a luxury. They're an absolute necessity. Vertiv is at the center of that demand.
Liquid cooling. So we're literally talking about running pipes and coolant inside the data centers right up to the chips.
Exactly. Direct-to-chip liquid cooling. You're basically creating a plumbing system to run coolant directly onto the surface of the chip to pull that intense heat away.
Yeah.
If Microsoft is spending billions, a good chunk of that is going to have to go to retrofitting their data centers with this kind of technology.
Okay, so VRT handles the cooling, but you have to get all that electricity into the building in the first place.
Which brings us to another name.
ETN.
Eaton.
ETN.
Eaton is a powerhouse in, well, power management and distribution. As these data centers get thirstier for electricity, the complexity of managing that power safely and reliably goes way up. Eaton provides the switchgear, the transformers, the backup power systems.
I've heard the electrical grid itself is becoming a major bottleneck here.
It's the biggest bottleneck. You can't just go to a store and buy a multi-megawatt transformer. They have incredibly long lead times to manufacture.
So if Microsoft is trying to accelerate its build-out,
They are almost certainly paying a premium to companies like Eaton to secure that equipment and jump to the front of the line.
and then finally someone has to actually put all the pieces together, build the buildings, connect them to the grid.
That leads us to a name like PWR, Quanta Services.
PWR.
Quanta is one of the key players in the actual infrastructure services. They help construct the grid connections, they build the facilities. They are the engineering and labor force that physically assembles the whole thing.
So it's a whole ecosystem. While NVDA gets the headlines for the shiny new chips, companies like ETN, VRT, and PWR are doing the heavy lifting to make sure those chips can actually be turned on.
That's a perfect way to put it. These are the physical winners, contrasted with the digital winners we started with.
All right, let's pivot a little bit. We've talked about the suppliers, both digital and physical. But there's a third group of winners here that, at first glance, might seem a bit counterintuitive.
The rivals.
The platform competitors. Now, explain this to me. Why would Microsoft spending a fortune actually help its direct competitors? Normally, that's a bad thing for you.
It comes down to two things: leverage and diversification. The more Microsoft spends, the more they validate that this AI market is real and enormous. But at the same time, they also scare customers into looking for alternatives.
Explain that fear. Is it just about Microsoft charging too much?
Price is a part of it for sure, but the bigger fear is something called vendor lock-in. CIOs, the people who make these big IT decisions, are terrified of being completely beholden to a single company for their company's AI brain. If they build everything on Microsoft's Azure and OpenAI, and then Microsoft decides to jack up the prices or change the terms,
They're trapped.
they're trapped. So they want what's called a multi-model or multi-cloud strategy. They want options. The report actually flagged a point from Reuters about this rising competitive pressure, specifically mentioning Google's Gemini model.
Okay. So as Microsoft's costs become more visible, customers start looking around.
They start kicking the tires on the alternatives just to hedge their bets.
So who are the tickers that benefit from this anyone but Microsoft, or maybe Microsoft plus one strategy?
The most direct competitor on the model side is GOOGL, Alphabet.
GOOGL.
They have Gemini. For high-end AI models, they are the clearest alternative to the Microsoft OpenAI stack. If an enterprise is getting nervous about costs on Azure, Google is probably the first call they make.
And Google's been pretty aggressive with their marketing, right?
Very aggressive. They're out there claiming their models are more efficient or cheaper for certain tasks. Microsoft's big spend basically tells the world that this AI thing is real, which gives enterprise customers the confidence they need to sign big contracts with Google, too.
Makes sense. Who else is in this group?
A slightly different angle, but you have AAPL, Apple.
AAPL.
Apple is a platform competitor, and their advantage is massive distribution. As they roll out their own AI features, what they call Apple Intelligence, they offer a completely different path to the consumer.
One that doesn't rely on Microsoft's cloud.
Not at all. They control the edge device, the iPhone in your pocket. Microsoft has to spend billions building data centers. Apple just needs to push a software update. It's a completely different kind of leverage.
And there's one more big one.
AMZN.
Amazon.
Amazon Web Services is the original cloud rival. Amazon Web Services is the original cloud rival. As companies decide to diversify their AI workloads, AWS is the natural place to go to hedge against Azure.
And they've taken a different strategy than Microsoft, haven't they?
Yes, and it's a very clever one. They've positioned themselves as the Switzerland of AI, meaning you can go on AWS and run a bunch of different models. You can run Anthropic's Claude, you can run Meta's Llama, you can run models from other startups. They give you choice, which is a very appealing pitch compared to Microsoft, which is so closely tied to OpenAI.
So, in a strange way, Microsoft's giant spending spree validates the entire sector, which ends up driving business to GOGL, AAPL, and AMZN.
It confirms the demand is real, while at the same time encouraging customers to shop around.
Okay, that covers the winners pretty thoroughly. The chip makers, the power and plumbing guys, and the rivals. Now we have to flip the coin and look at the other side of the ledger.
The losers. Or at least the entities that are now facing the heavy burden of these expectations.
And logic dictates we have to start with the company that started this whole conversation.
Microsoft itself.
MSFT. Now, why are they in the loser column here? They're still making a ton of money. The company is growing.
They are. But they suffer from what you could call the mega cap problem. When you're one of the biggest companies in the world and you spend at these record levels, just okay, or inline growth, is simply not good enough.
The bar gets raised.
The bar gets raised to an almost impossible height. The market doesn't just want growth, it demands acceleration. If you spend an extra $37 billion, investors want to see revenue growth speed up, not just stay the course.
And when it doesn't?
Then you see something called multiple compression.
Let's break that down for our listeners. What exactly is multiple compression?
The multiple is basically the stock's price-to-earnings ratio. It's the premium that investors are willing to pay for a stock based on their belief in its future growth.
So it's a measure of faith.
Exactly. If investors believe Microsoft will grow profits at 20% forever, they'll pay a high multiple, high premium. But if they see this massive spending and start thinking, wait a minute, their margins are going to get crushed by depreciation on all this gear and soaring electricity costs,
then they're not willing to pay as much for each dollar of earnings.
that's it. They decide to pay less. And so the stock price falls. Even if the company is still growing and profitable, the valuation itself shrinks because the future just doesn't look as profitable as it did before.
And it's worth pointing out, Microsoft even tried some accounting moves to help the numbers look better, didn't they?
They did. They extended the useful life of their servers on the books from 4 years to 6 years.
Which does what?
It reduces the annual depreciation expense, which on paper makes their reported profit look higher. But even with that accounting tailwind, the market was not impressed. That tells you how focused investors are on the raw cash flow.
So MSFT, the primary subject, ends up on the loser list because their own spending raised the stakes too high.
For now, yes.
Are there other big legacy tech companies caught in this same kind of trap, this pressure to execute perfectly?
Definitely. You could put a company like ORCL Oracle into this bucket.
ORCL.
And probably IBM as well. Both are legacy tech giants trying to make a big pivot to AI in the cloud. And they are both subject to the exact same intense scrutiny from the market. If they announce big spending plans, they have to deliver flawless execution.
And if they don't?
The valuation gets punished hard. Oracle, in particular, has been making very bold promises about its AI cloud growth. If they miss expectations even slightly, they'll see the exact same negative reaction that Microsoft just did.
It's a tough spot. You have to spend billions just to compete, but the moment you do, the market punishes you unless the return is immediate and massive.
That is the modern mega-cap dilemma.
Now, this feeling, this sentiment, it doesn't just stay confined to the big guys, does it? It tends to bleed out into the rest of the software market.
It does. Which brings us to our next category of losers.
Mhm.
High multiple AI software stocks.
What's the dynamic here?
You could call it optimism cooling.
Optimism cooling.
When the market starts questioning the return on investment for a titan like Microsoft, investors get nervous about the entire AI narrative. They start asking a very logical question.
Which is?
If Microsoft, with all its resources and all its customers, isn't seeing a huge immediate margin boost from AI, why on earth would a smaller software company see one?
There's also a deeper worry here, isn't there? About the whole seat-based pricing model that so many of these companies rely on.
Yes, that's the seat-based pricing problem.
Yeah.
Many of these companies, they charge per user, per seat. But the whole promise of AI is productivity. That one person can now do the work of, say, 3 people.
So if a company's sales team becomes 30% more efficient thanks to an AI tool,
Maybe they don't need to hire as many new salespeople next year, which means they buy fewer software licenses. It's a potential deflationary pressure on revenue for a lot of these enterprise software names. The market is starting to worry that AI might actually cannibalize growth before it adds to it.
so who are some of the tickers getting hit by this cooling sentiment?
Well, the prime example would be CRM, Salesforce, the absolute giant of enterprise software. For them, investors are demanding clear proof that their AI products are driving new revenue, not just helping their customers get by with fewer paid users. Until that proof materializes, the stock could struggle.
Who else is in this group?
Another one is NOW, ServiceNow,
NOW.
a fantastic company, very successful, but it trades at a high multiple. It's very sensitive to these kinds of shifts in sentiment. The stock is priced for perfection, so if the market starts to think that enterprise AI adoption is hitting some friction,
ServiceNow stock is one of the first to feel that pinch.
immediate.
And there's one more in the creative space, right?
ADBE.
ADBE.
For Adobe, the scrutiny is all about AI monetization in their creative tools. The worry is competition from all these new generative AI tools like Midjourney for images or OpenAI's Sora for video.
The question is, are customers paying extra for Adobe's built-in AI Firefly, or are they just leaving the platform for these new, more focused tools?
Exactly. And as long as that answer is murky, the stock is going to face headwinds.
So for CRM, NOW, and ADBE, it's about waiting for the hard data to catch up to the initial hype.
They're stuck in the show me phase.
All right, let's move to our final group of losers. This one operates on a slightly different, more immediate mechanic. We're talking about cloud consumption and data platforms.
This is all about budget tightening.
How does that work? Why are these companies more sensitive?
Because they typically operate on a consumption-based business model.
Meaning they charge you based on how much of their service you actually use, not a flat subscription.
Precisely. It's like your electricity bill. You pay for what you consume.
I see.
So when big companies experience what we can call enterprise caution, when the CFO sends out a memo saying we need to tighten our belts on cloud and AI spending, these are the very first companies to feel it.
Because it's easy to just turn down the dial.
It's very easy. You can't just cancel a multi-year Salesforce contract halfway through the year, but you can absolutely tell your data engineering team to run fewer queries on your data platform starting tomorrow to save money.
So unlike a subscription where revenue is locked in, with consumption models, the revenue can drop almost instantly if a big customer gets cautious.
Instantly. It gives them a lot more volatility. If there are capacity issues or pricing changes, it shows up in their guidance immediately.
So who are the key tickers to watch here?
The poster child for this model is SNOW, Snowflake.
SNOW.
As a data platform, their revenue is extremely sensitive to these consumption trends. And they're also facing a bit of a technical headwind right now called iceberg tables.
Iceberg tables, what's that?
It's an open source data format. It basically allows companies to store their data more cheaply on something like Amazon S3 instead of paying Snowflake's higher integrated storage rates. As companies look to cut costs, many are moving data to these open formats.
And that directly hurts Snowflake's storage revenue.
It does, so they're getting hit by both budget caution and a technical shift at the same time.
Who else is in this consumption bucket?
DDOG Datadog.
DDOG.
They're in the monitoring space. They monitor cloud usage and performance. So if overall cloud usage growth slows down because companies are pulling back.
Then Datadog's growth slows down too. They're a direct derivative play on total cloud volume.
Exactly.
What about from the database angle?
There you have MDB, MongoDB.
ChemDB.
As a database platform, their revenue really ebbs and flows with the general appetite for enterprise spending. When budgets get tight, developers build fewer new applications, which means MDB sees fewer new database instances getting spun up.
So SNOW, DDoG, and MDB are really the canaries in the coal mine for enterprise IT spending?
They are. Their results often reflect the real-time, on-the-ground decision-making of IT departments across the economy.
Okay, so we've followed the money all the way through the system. From the initial check Microsoft wrote to the winners who cashed it to the losers who felt the downstream effects. Let's try to summarize the whole trade here.
I think the central theme is that this kind of massive spending from a major player like Microsoft creates a really clear, almost binary outcome in the market. It creates a fork in the road for capital.
So on one side of that fork, you have the money flowing out.
Right. Money flows out of the spender itself, MSFT, because of the margin concerns. And it flows out of the more speculative software names like CRM and SNOW because of the uncertainty around ROI, the immediate fear of budget cuts.
And then on the other side of the fork, you have the money flowing in.
Exactly. The money flows directly into the builders, the NVDAs and the ETNs of the world. And it also flows into the rivals, like GOGL, who benefit from the overall market validation and customers looking to hedge their bets.
It's a really clear redistribution of capital. The headline just says Microsoft earnings, but the real story is about how the entire tech ecosystem reacts to that single $37.5 billion data point.
That's the market we're in right now.
So before we wrap up, I want to leave our listeners with one final thought to consider. We kept coming back to this idea of proof. The market is demanding proof that all this AI spending will eventually translate to higher margins.
That is the single most important variable right now.
So the question to think about is this: how long will investors wait for that proof before this cooling of optimism we talked about becomes a much longer-term trend?
It's a great question. If we get through another quarter, or maybe 2 more quarters, and we're still see 60+% Capex growth and revenue targets that are only barely being met.
Does the market's patience run out completely?
That is the question that I think will define the direction of the market for the rest of this year. If those margins don't start showing up in the numbers soon, the entire AI trade as we know it could go through a very painful correction.
Something to think about. That is all the time we have for this edition of Breaking News to Trading Moves.
Thanks for listening.
And just a quick reminder before we sign off, nothing discussed on this show constitutes financial advice or any recommendation to buy or sell any securities. The content represents purely the opinion of the hosts. Please be sure to do your own research before making any investment decisions. We'll see you next time.